Boom. All right. It says it's recording. Welcome, everyone, you guys on screen with me, but also the rest of the world. This is the first official episode of Security Tokens Uncensored. I am Alon Goren. With me today, I've got Andrew Dix from Crowdfund Insider, Crowded Media Group, Jor Law, founder of Verify Investor and now head of Issuance at tZero, and Kinsey Cronin from PrimeTrust. Guys, so I'm here today because one, we did this thing last week and it was a lot of fun, and I figured I should do this regularly, get my friends on video, talk about Security Token Summit, talk about CIS and what's going on in the space in general with security tokens. And this crew that I got on this first official episode is here because we all share a common background in the crowdfunding space. And you know, I'll go one by one and everyone will give their backgrounds, but we you know, we're in the crowdfunding space for a long time, and because of that, we learned all the rules around Reg D, sort of 506C, the public kind of offerings, regulation crowdfunding, Reg CF, Reg A+, and all of the rules around all of that. And so now that security tokens are starting to take over, or starting to be this new wave in the crypto space, we're all sort of uniquely qualified to answer questions about what most of you are doing. So
you want to appear like we're qualified, right?
We feel like we are. We feel like we are. And we for many years reluctantly learned way more than we ever wanted to know about some of these rules and laws. Jor, you know, has a background as an attorney, so he knew more than all of us, and was always one of the first people we called. But in general, you know, we thought it would be fun to talk about the crowd, or fintech in general, our backgrounds, and how we got to this space, and set the stage for a fun conversation here. So because I'm just looking down at the way Zoom put our images, at least for me, I thought, Andrew, why don't you give us a bit of background, and we'll start with you.
Yeah, so I founded Crowded Media Group back in the very early days of crowdfunding, as Alon has just shared, soon after the Jobs Act was signed into law. And as Alon said, the Jobs Act created these exemptions, these security exemptions, which allowed online capital formation. This includes Reg D 506C, Reg A+, and Reg CF, regulation crowdfunding. Over the years, I think that online capital formation kind of was the genesis of all fintech. People started to think, well, wait a minute, if you can do that online, I can do all these other things online, and the industry blossomed. And then along came ICOs, and we kind of started covering ICOs simply because people started sending us all this information about them and saying, look at my offering, and we're like, what is this? Now we're at the STO phase, which is effectively compliant ICOs, or security token offerings, or digital securities, or smart securities, whatever you want to call them. Right now they stand as securities blockchain. And I think it's a fascinating industry, and I think that we're in the very early days of something kind of cool.
All right. Yeah. So before I even get to Jor, the sort of impetus of all of it from my end too was what you were saying with the online fundraising and the crowdfunding. So my original idea from my last company, Invested In, came while I was working at MySpace. And there was 1 year at MySpace where there was this funny sort of vanity metric that doesn't really mean too much, but was really funny, was on the online gaming that was going on Open Social, which was like the network across Google and Friendster and Bebo and MySpace where people could play games. Farmville had sold more digital, you know, tractors in the game, like sold for real money, digital John Deere tractors than John Deere sold real tractors in the real world. And I remember thinking that and going like, how could we use this technology to help people raise money online? And that was, you know, that must have been 2008, 2009, something like that. So Jor, give us your background. Would love to hear it.
Yeah, so I'm a corporate and securities attorney that's just been interested in tech and, you know, just random side businesses kind of all my life. And within the space, you know, I got into crowdfunding largely because my law firm had clients that were always looking at alternative finance. And when crowdfunding came up, we were one of the early law firms in the space. You know, when the Jobs Act was announced, I created a company called Verify Investor, started thinking about what a product for crowdfunding would look like that ultimately became verifyinvestor.com, which was a Title II solution. And, you know, just through a couple of the different companies I'm involved in, they all were servicing crowdfunding one way or another. And as everyone started doing these ICOs and looking at blockchain, I never really got into it because I looked at it and I just thought, okay, well, this is great. This is like a ledger technology. You know, a nicer, you know, database or a nicer spreadsheet or a nicer, you know, ledger doesn't necessarily change everything. But one thing that I thought it would change was security tokens. So long before people were focused on security tokens, I started looking at it and saying, you know, thinking, how can I get more involved? So our law firm was talking about security tokens before everyone else admitted they were security tokens. Verify Investor started, you know, trying to tell people like, hey, you can verify and do it the right way. So we had some of the earliest STOs kind of came through our platform. I was a director of PrimeTrust, and it was a escrow provider in, you know, crowdfunding. And, you know, I led the charge to tell them like, let's get into blockchain custody. So, you know, that's kind of how I got into the space. You know, I drank the Kool-Aid and started helping people build the infrastructure. I got involved with companies like Polymath and tZero to really kind of help them build their product and or their business.
Yeah, I mean, because once ICOs started seeing what was going on and people at least were, if not being compliant completely, they were at least at a certain point starting to realize they needed to verify people were accredited investors and do things right. And a lot of them did use Verify Investor, right?
Yes.
Yeah. So that was a good segue to PrimeTrust because Kinsey is at PrimeTrust. Kinsey, give us your background, because I know even before PrimeTrust, you were in crowdfunding.
Yeah, I remember meeting you years ago at a conference or around a conference table and hearing about some of your plans and thinking like, who's going to show up to that? But no, I wasn't doubting. I was just wondering. And
Sure.
now I know the answer. I started working in, specifically in equity crowdfunding under Reg A+ and Reg CF before some of those laws came into effect. On the platform side at Start Engine, working directly with the issuers and kind of working through what that was going to look like. We had no idea what it was going to look like. It was very much modeled after Kickstarter. So we were designing these campaigns around what had worked in the crowdfunding world, not so much about what had worked in the traditional like IPO world. And I remember turning people down who wanted to have their investments made in Bitcoin, saying like infrastructure, we can't even, we're not going to invest in the ability to make that possible, to make that payment possible. That was pretty early on. Obviously, we've changed our teams a lot since then. And at PrimeTrust, we're doing a lot more than just the initial offerings. Basically, the shift came, as you guys have mentioned, when ICOs were raising a lot of money. People were talking about them. There became this big demand for them. And the realization seemed to hit many of us at once who've been working in crowdfunding that like we had this whole legal infrastructure in place and we knew what we were allowed to do, but what we were executing was not nearly as successful as what ICOs were executing. And of course, they were making some mistakes that we weren't willing to go into sort of the illegal territory we were observing. But we could see there that was the opportunity, that if we could kind of bring these two worlds together, that was where success was going to live for us.
That's awesome. And you guys are, like a licensed custodian as well. It's not just,
Yeah, well, so PrimeTrust is a registered, regulated financial institution. It's a trust company, but it's also really even more so. It's a tech company that provides the technology necessary to do this in such a new way at scale. So doing legal compliance and onboarding potentially thousands of customers at a time for different projects, and making sure that all of that sort of banking type of work is handled on the back end for businesses that are managing their platforms, whether it's marketing, it's marketing and it's all the front end customer service stuff. It's the design of their product, but they still ultimately need to meet certain regulations. That's what we're doing on the back end.
Cool. Yeah. I mean, because if I go back to the original ideas at the MySpace days, we called it social fundraising because even at the time the word crowdfunding didn't exist. So if you look at all those original domain names I bought around it, it was about fundraising, social fundraising, and we had no idea what we essentially wanted to do was illegal, because even the first examples that I put in the first decks that I had outlining invested in, it was, I'm going to raise money for my company. I'm going to sell my services in advance, but the people who support me at the beginning are going to own a piece of the company. And at that time, I had no idea that you couldn't post on Facebook or MySpace or Twitter or whatever, that your company was fundraising, because I was just this idealistic techie. But once the rules did come through and we were looking at, crowdfunding from the Kickstarter days, there was a bit of a sad realization once it did become legal that it is much harder to get somebody to invest in a company than it is to sell them a product, right? I mean, Andrew, I'm sure you saw this at the very beginning.
Yeah, why is that? I mean, that always kind of perplexed me as to why is it easier to sell, tickets to a movie or a t-shirt than to actually purchase ownership in a company that you think has potential?
So I saw this like times 50, because we probably had 50 or so clients over the years that invested in that. We powered eventually we didn't have our own crowdfunding site. We always did, but it was more of a testing ground for features and stuff. We powered other people's sites. And what I learned from everybody's is that humans are very, as a group, I don't mean, there's lots of individuals who aren't this way, but as a group, people want instant gratification. They don't want to wait for anything. They want, and they're selfish. And so if you say, I'm going to give you this thing, and you basically are going to instantly get it, people are willing to buy that. And they don't really realize, and people, especially if you're in the crowdfunding stage, you're probably even earlier than most early stage startups, and most early stage startups, if they're successful, which most aren't, take 8 to 10 years on average to get some kind of exit. So people don't value that as much, at least yet. The culture might change and people might learn, but people just never really got it or understood that part. But now there's these hybrid models in different places, right?
Yeah, there's hybrid models, but I think part of the weakness of the reward space is that it's effectively e-commerce. I mean, really, when you look at the vast majority of sales that goes through that system, it's really e-commerce. When I think of crowdfunding, I think of securities crowdfunding, I think of investment crowdfunding, I think of mainly early stage investing today, but I expect to see that to go further on down the capital stack, where you're going to see more mature companies that leverage online capital formation to raise the growth capital they need. And I think security tokens is part of this evolution. It's just we're very early, and there's a lot of education that needs to take place. And then there's some other issues which I'd like to learn about as well, if I can.
Well, Jor, I mean, you saw companies who the more legitimate crowdfunding deals, right? Because you would see, you kind of were across the board, touched almost all of them, because you guys did provide the infrastructure to at least verify the investors and take some of that liability off of people's hands. What were some of the things you saw, trends that the successful companies versus the unsuccessful companies in their deals?
Yeah, no, we were fortunate that, you know, if you were gonna do a crowdfunded deal or a STO deal using Reg D 506C and you wanted to do it correctly, you know, there was a good chance you ended up using verifyinvestor.com. So we got to see a sample, and you know, consistently, I think the better deals, or the, well, let's not say better deals, but consistently the deals that seem to perform the best were either going to be, you know, they fell into one of two camps, right? Either we saw that they had a good professional team around them, so that they took the offering seriously. You know, they structure it right with good professional teams. They weren't greedy on the capital raise. You know, they really put out a product out there that they thought was a good product and was, you know, something that, you know, the public would like. In some cases, losing money on the first deal.
Yeah.
And that was successful. The other ones were people that kind of understood how to market to the crowd, and actually we took efforts to market to the crowd. You saw a lot of people that thought that they could crowdfund by just throwing up a website and maybe going to a portal and saying, oh, put me on your portal. And the reality is, you know, most of the portals didn't bring them investors. They brought investors to the portal. And
you're talking about Reg D 506C, which is different from the other two exemptions.
Well, I mean, in all cases, I would say I was constantly, there's a few things to unpack with what George just said that I tell people all the time. I said it the other day at the Security Token Academy event, one, people would go to crowdfunding platforms as a last resort because they went, oh, this is this new novel way of raising money. And because they couldn't raise money any other way, they thought this is the magic.
Right.
So that was never a good reason to get into it. But the one most important thing was on Kickstarter and not these other places. I bet Kinsey would have a bunch of insight into this, is people thought that the crowdfunding platform, the portal, would be the one that brings them the investors. And the best thing you can say about any of the platforms, the best ones, is that they could maybe amplify the work that you do. There's no amount of I don't even know. There's no amount of effort that you could give that wouldn't be sort of amplified by a good portal. But if you don't do the work yourself, you don't do the marketing yourself, it's never going to happen.
Yep.
Yeah, and I mean, coming from the portal side, we told people that as much as we could. There was some value that came in from the portal. Typically, you know, it would be between like 15 and 40%, sometimes 100%, but those were never high raises, right? Yeah. So, you know, typically there was the more that a company was doing to raise, to gain attention and to gain followers on its own, that was always going to sort of wash back into the larger community that the portal had. If they had nothing and they didn't have a good argument, then it didn't matter how many times a portal hit up its own email list, because the thing that wasn't working in the larger scale wasn't going to work within the crowdfunding community either.
So Kinsey, you're saying the value that a portal brings is the structure of the offering and the presentation. It's not the marketing.
I honestly would say that the main value that a portal brings is that it's kind of like a mind-bending process to go through, and a portal is a guide and has a lot of built-in tools that kind of says, okay, now you do this, now you have to do that. This is how long it's going to take. These are the people you need to be working with and hiring. Going in like fully blind, or just going in with like a lawyer and a marketing team, like it could be great. People have done it really well with just a legal team and a marketing team on their own, but it is pretty difficult, especially for like a regulation crowdfunding campaign that's only going to raise up to $1 million. It's really difficult to do that. So I'd say that seemed to me in the end to be the biggest value. And then there was a lot of marketing value that came in as well. It just wasn't the main draw.
Yeah, I think that the portal, so I'm actually going through it right now with one of our companies. I can't announce it yet, that we work with is going through launching a deal. And they're going through, and the playbook that the experienced portal gives you is invaluable because they've done it a million times. They could streamline the process. They could save you some heartache. But the thing I always would tell people is that if you can't sell it on the internet, then it's going to be really hard to sell. You know, if it's a product you can't sell through like a Facebook ad, and not necessarily a Facebook ad because it might not be legal for the campaign, but if you can't sell something in a Facebook ad, it's probably not going to be a good campaign. And the where I was going with that as well is you mentioned the shit, I totally sidetracked my brain with that thought. I don't say something.
Let me ask you a question. What's your biggest beef with online capital formation in the US? And I'm talking about Reg CF, Reg A+, and Reg D 506C. I don't want to get into the nitty gritty of what that all means, but basically these 3 tiers of the securities exemptions that you can utilize to raise money legally and compliantly online. What's your biggest beef with the industry today?
Who are you asking that, or to everybody?
I want to ask Alon first, and then I want to hear your answer. And Kinsey's too.
So my biggest beef is it's funny because I think a lot of us got into this for the reasons of efficiencies and sort of leveling the playing field in a way that allows everyone to participate in everything. So like I got into it because I thought, how come a startup in a random small town couldn't do something, or a person who is launching literally that example that was illegal that I put in the invested in deck was a friend of mine who wanted to quit his job because he worked at a landscaping company to start his own landscaping company and have his first clients be his evangelists and own a piece of the company. It sounds tiny compared to these, we're talking about unicorns and billion-dollar companies in the crypto space, but it's life-changing for small towns and people around the world. So my biggest beef was that it was illegal at first. Then when it was legal, the verification process, things like what Jor did and fixed the process, made it so that if you are public about it, then now you have this extra liability on yourself. That's going upstream into the startup world. But now my biggest beef really is just that people talk about the accredited investor laws and how it's being, might be fixed, and how there might be, what are the tests to make sure that you are basically smart enough to what's it called? I'm just
the accredited investor test.
The sophistication test. So people are saying, well, if you're not an accredited investor, maybe we'll just make a sophistication test to see if you're sophisticated enough to spend your money. And my biggest beef in general is that there's too many rules and hoops and laws to go through it all. But that's just insanely offensive and un-American and crazy. It's just saying that if you're not wealthy enough, then you're stupid and you're not smart enough to participate. So that stuff drives me insane, and that's where I kind of go nuts. But in general, there's just too many hoops. And what Jor built with Verify Investor, what we were building with Invested In, what Kinsey is doing with PrimeTrust, and all of this stuff is making it easier to deal with the laws that kind of make you jump through ridiculous hoops. There should be laws. People should not be allowed to scam people. Obviously, people should be thrown in jail, and there needs to be recourse on all these things. But they're
illegal, yeah.
And they're not global, and they're a pain in the butt to deal with. So that's my biggest pet peeve, and I know I kind of circled around a lot.
Yeah, I think touching on a few points, I think the portals over time the investor base that they create will become more important, kind of like a Kickstarter. Right now, yes, you have to do your marketing, but the underlying base of Kickstarter, it will actually look for investments not investments, for sales and purchases that they might be interested in. So I think over time the portals will develop that, and certain portals will develop perhaps a certain demographic which may make them more fit for a particular type of deal than not. But that will take a while. I think when we all kind of got into crowdfunding, it was a very different business because raising capital from the crowd using kind of social finance for people that were buying and holding things, that's the world we grew up in. The world that, got thrown upon us, a year ago or so, a year and a half ago, was this world where there was a promise of secondary trading. And then for a period, you had this illegal capital raising moment where people would actually structure things, not necessarily for the benefit of price stability in secondary trading, but to maximize the likelihood of getting a large initial sale. And while that ICO craze, has died down to some extent, and a lot of that was not done legally, you now have STOs that are coming up, and they're growing up under the advisement of some consultants that grew up in ICO space, and they're growing up under, they're getting consultants that grew up under crowdfunding and regulated roles, and they're trying to figure out, like, what should we do? Where is the balance? Because frankly, if the secondary trading tanks all the time, then this is going to kill the entire market for quite a while. And you get people playing around with structures that sometimes incentivize a more successful initial sale, but also incentivize, immediate dip in the marketplace when they sell. In terms of a pet peeve, just to answer the question you directed, Andrew, in general, I like the Jobs Act. In general, it's a step in the right direction. I'm not going to look at a gift horse in the mouth and just say, oh, it was horrible, and be unappreciative. That being said, kind of difficult, kind of impractical, especially Reg CF. The amounts are not economical. They should at least make it a larger, capital raise. Maybe get rid of some of the requirements, but really, if they raise the maximum capital raise, that would do a lot. Reg A plus, same thing. They're caught in this space where if it was like the max raise of $150 million, that might make it more palatable, and the burdens may not be that bad. But on the other hand, Reg CF going to 5 million, I see immediate benefits. Reg A going from 50 to 150 million, unless we get quality issuers that want to do that, and unless we get investors that are interested in funding those types of amounts, maybe it's a request that doesn't need to come through.
So I agree with both you, Alon, and you, Jor, on what you all said. And there's a couple things that I think are very interesting there. And I still want to hear what Kinsey has to say. But you also said the ICOs, the STOs. I think that's a big question right now as to whether the ICO enthusiasm or euphoria or whatever you want to call it, if that's going to transfer into the STO space. I don't know if that is, and I'm kind of curious what you think, but I also want to hear what Kinsey has to say.
So the original question being about our beef with the industry, right? I think to me it's like a combination of lack of technology in the older systems and also lack of education in the general public. I mean, this is just not something that most Americans don't like learn in school or expect to be spending their money investing. Like earlier, you're saying you don't understand why is it easier to get somebody to buy something than it is to get them to invest in that exact company that's making the cool thing. It's because they're not used to doing it. It's just not something that they've done before, that they've considered at all, or that they've seen as part of their future. It's not something their parents have done. So that's, I mean, if you're coming from a background where there is a lot of wealth, which is obviously a smaller percentage of the overall population, then that might be an expectation. And then in that case, you're going to be investing larger amounts of money. But if you are trying to participate in this like more widespread, smaller investment per investment, we don't have a culture that's really been prepared for that. So you have to educate people and they have to feel comfortable doing it. It's a lot easier to feel like, here's my credit card. I'm going to buy a backpack. This is the coolest backpack. I can't wait to tell all my friends about it. Than it is to say, okay, I'm going to pay maybe 5 times that much to invest in a backpack company and still tell everybody about it. Because of the long-term return on that is going to be huge, because you're not thinking that way. You've just never done that before. So for me, it's that education is something that we have to, everybody's participating in, and it's just sort of the nature of it as it becomes more well-known that people are going to be doing. But for me, I think the thing that annoys me is that our current systems on the traditional side of fundraising are so complicated and outdated, and they really don't make any sense. There's just so many legacies in our trading systems, and there's so many middle people that are required. And, if it's the second Tuesday on a leap year, then there's a loophole that you can take advantage of. And then, if you also look at sort of historical, like the historical patterns that have led to fewer and fewer companies even being able to IPO, which is one of the reasons that we needed Reg A Plus to make it possible to get that kind of liquidity for a company that maybe 30 years ago could have just gone public. So that to me is the two things. It's like we've got this big education gap, and then we also have completely outdated systems that in 2019, with the kind of technology, like the leaps and bounds that technology has made over the last 20 years, just doesn't make sense that it hasn't expanded into the financial sector.
Yeah, the dinosaurs still rule, huh?
Yeah, not for long. Not for long.
Dinosaurs will die.
Yeah, it's challenging, Andrew. You kind of asked if the ICOs would translate to STOs, and really what drove ICOs was pure gambling, right? So, what drives STOs hopefully is going to be less gambling and more investing. And to Kinsey's point, we don't have a culture, at least not in the US, but many places internationally, we don't have a culture of saving and investing and knowing how to invest. Especially in kind of a litigation-backed culture like the US, right? If the first thing that happens when someone loses money is that they go sue someone else, instead of they think about, well, was I, careless in investing? Like if someone doesn't look internally to see why they might have lost money in the first place, and they immediately go to try to sue people, then it's always going to be hard to kind of get the masses involved. The best bet we have in blockchain, I think, is, for securities, is that, it is superior technology for securities market. Securities market is a vibrant and thriving market. And if that whole market adopts blockchain because it's just better technology to do it, then STOs will have to succeed, not because everyone got involved, but because the existing market adopted better technology. Now, the hope would be over a period of time, the laws, and we're already moving toward that direction, right? Globally, crowdfunding is a thing now, and the Jobs Act is there now, and people are now taking steps to try to make it even more accessible to non-accredited investors, right? If we can combine that movement with the education that Kinsey's talking about, so that people will look to themselves and kind of make better decisions when they're investing, we have a shot of changing how finance works, and not just for the betterment of all companies, but the betterment of people who can take investments into their control and hopefully lessen the opportunity gap between the haves and the have-nots.
Yeah, I think it's all converging in different ways, right? Like the information side, the technology, and now these laws around fundraising, and so I use real estate as an example all the time, because I feel like it's just like in the crowdfunding world and tokenization space, it's probably going to be a bit of an on-ramp for people who aren't as maybe in the know in the tech startup world or really even interested. But like, I can explain to my mom that, it's just this access, right? It starts off with access, because none of us would have been, or maybe not us, but I definitely, or maybe my family would never be able to just go like, hey, I want to buy that piece of commercial real estate. No matter how attractive or exciting it might be to own that commercial real estate, we just couldn't afford it. It takes millions of dollars, or bank connections and leverage and different things that none of us know anything about, right? But if I go to my community and I go, hey, did you know that the building the Starbucks is in on the corner is now being sliced, pun intended, into a million pieces, and you can buy a piece of it for as little as $1,000. And my mom and her friends that literally walk to Starbucks every single Saturday and Sunday morning from their neighborhood could find out about that and go, you know what? We want to own a piece of this building. We could put in $1,000 and every month get a $10 dividend directly into our wallet. That would be pretty cool. And that's what technology is doing. And the education part is going to start making it, I think, a little more palatable and easier.
So that's the hope, the dream, and the vision. How long does that take, Alon?
I think it takes a while. Sorry to jump in, but I think sure. So we all have been taught, like, we're all used to this conversation. I was the first one to drop that in, like, wouldn't it be great with the backpack or with the Starbucks building if this was an opportunity available? But the thing that we've all, the reason it takes a while is because now what if that same Starbucks building is actually being run by people who are kind of desperate and are taking advantage of the community? So technically, yes, it's for sale. Don't you want to own this cool building? But they're maybe not really going to manage it well. And because your mom isn't really in this world, this is an opportunity for her once, or it's the first time she's run into this opportunity, she isn't educated enough to know whether or not, she doesn't know what questions to ask, right? So she's got to have some trust. And that's one of the really important parts of it for educating the community, because we have seen in the ICO and in the crowdfunding space, we've seen companies do really poorly or not really be what they led themselves to be, or they misled them.
Well, I think trust is a big factor. Sorry, I was just looking down. And the thing that's interesting is everybody talks about how there's this gap between the haves and the have-nots, and the people that have millions of dollars get access to deals and the ones that don't get access to deals. But there is statistics out there, and there's clear-cut proof that shows that a majority. So I've done this in the past for different decks and presentations I've worked on, but the majority of capital raised in, I think in the world, but I'll say the United States because I'm more confident about that. A majority of the capital raised in the United States is raised by third-party marketers. Most, that means people, broker dealers and bankers who actually represent each one of these deals. And because we're in the startup world, we might think, well, the CEO of the company goes and pitches to investors, but a majority of the money raised in real estate deals and all the rest of the deals that happen from third-party marketers. So there's a company who's basically staking their reputation on the quality of the deal. Something like that has to happen for the masses as well.
Yeah, it's not necessarily bad.
I think that the very best deals available should be open to the people who need it the most. I think the opportunity should be for the masses, not for the few. And I think that's where the regulators and the policymakers, the politicians, they got it totally wrong. They're like, we've got to save these people because they're not smart enough, instead of saying, how do we get the best deals to these people that need to shrink that wealth gap that has emerged too far in this country?
Yeah, they've definitely overcomplicated things. I mean, look, from a accredited, non-accredited perspective, I think in the current climate, the non-accredited market, even with the legal changes, et cetera, even if they could come in, it's going to take a while. It's going to take a while because if you go down to the street and you randomly grab people and you ask them, hey, what's your favorite company in the whole wide world? A lot of them will say, oh, Apple, Nike, something like that. And then if you ask them, hey, did you know you could invest in them? Maybe a percentage of them will say no, but a fair amount of people know that Apple is a public company. They know Nike is a public company. They know they could buy stock in that. Then you ask them, do you buy it? And a lot of them are going to say no. So and that's your typical non-accredited investor, right? The company that they love more than anything, they won't even invest in. And now you're going to try to sell them a complicated financial product. online. So without the education, I think that's a ways off. The reason why I think that I'm still optimistic that tokenization takes off is a few things, right? If you ask anyone, basically, hey, are paper stock certificates better or digital stock certificates better? Most people are going to say, well, digital. Then if you ask someone the next question, which is, hey, if you could just trust one person to keep track of that digital stock certificate, would you rather do that, or would you rather trust 20 different people for not much more cost or less cost and to keep track of that? Most people will say, yeah, pretty good. Let's have multiple people keep track of that. Well, if the answer to both of those questions is yes, then there is no publicly known technology that allows that delivers a solution other than blockchain or decentralized ledger technology, right? And that alone isn't sufficient for market to get adoption. But when you get all the major players, like every major investment bank, Goldman, JP Morgan, even the retail banks, Bank of America, et cetera, and then you get the exchanges, NASDAQ, New York Stock Exchange, they're all looking at this and they're all saying there's going to be a future here. Suddenly I'm optimistic that this is really going to be a thing where people are going to move into this industry, and then hopefully later the non-accredited investors come on as well.
So you're saying the back office, it's not very sexy, but it's really important, and right now it costs a lot of money, which I agree with. But I think that the vision of STOs comes with increased liquidity and access, but also new asset classes emerging that makes it easier to participate in promising ventures or other types of real estate or whatever.
Yes, but new asset classes is probably a little bit more complicated as well. There's nothing that you can do with a token that you couldn't duplicate through some sort of investment contract on paper, right? So token is just, it didn't change what you could do, but it changed human behavior. It changed what people would do, within the realm of possibility. But to your point, Alon, is with the current laws, they don't make sense. Look, I run a credit investor verification company, right? This company probably makes more money doing accredited investor verifications than, pretty much anyone in the world. And it's not a business we necessarily want to be in. I mean, the verification laws to prove that you're accredited don't all make sense. And then it's asinine, the evidence that someone has to come up with repeatedly. And then also, it doesn't protect the investor. The issuer that's going to scam the investor is still going to be there to scam the investor. Now they just might have more information to scam the investor with. But the other thing also is this whole definition, right? If you really wanted to get the masses involved, and if the whole premise was that, oh, they don't need protection because they're either rich or they know better, right? So let's deal with one of them. If the idea is that they're rich, they can afford to lose money, well, fine. Then I guess if that's your premise, then the poor should not have the same investment opportunities. But if the idea is that we don't want the rich to only be able to invest in opportunities, we want more people to invest in it, then you would have to let, I guess the poor come and invest as well. If the idea is that the rich can invest because they're more sophisticated, then I say that's bullshit. A lot of accredited investors are not particularly bright, and a lot of non-accredited investors are very bright. So
I agree.
So one of the solutions might be, well, if you're worried that they can't protect themselves, instead of telling them they can't do anything, what if you just said, no matter what you invest in, you sign this separate statement. It's the same statement for everybody that says, no matter what someone has told me, I realize this is risky. I could lose money. These are the types of reasons why I could lose money. It's just a one-page disclaimer. So they actively sign it. And then you have some requirement that says for every deal that is open to non-accredited investors, X% must be bought by accredited investors, right? Then if it was good enough for the rich, it's good enough for the poor, theoretically, and maybe you get rid of a lot of this verification stuff and you open up more opportunity.
I think you make a good point there. And the way it's structured right now, the government has disenfranchised the vast majority of the population, and that's not good. In fact, history shows us it's a bad thing to do. And there's still people on Capitol Hill that want to make it even more difficult for the smaller guy, the little guy, to gain access to promising ventures. But I remain optimistic that something will happen at some point in time in this Congress.
I think that, you know, using Verify Investor as an example is the rules and laws are going to change. Government's going to be much slower than we ever want them to be when it comes to changing them. And they're probably never going to be perfect, and they're probably going to screw a bunch of crap up. And that's just a part of it. But Verify Investor is an example of a rule that's kind of insane, right? Because they basically didn't change anything other than who is liable for lying about verification. So before the rules changed, I would put a piece of paper in front of an investor and they would check 3 boxes basically saying that I'm an accredited investor, I make this much, I do this, I do this, I do this. And then if they lied to me, I could show them that piece of paper and I said, well, you are the person who said you can afford this and you're allowed to do this. And what changed was when you publicly solicited, if Kinsey lied to me, she could then sue me after the fact and say, I wasn't actually an accredited investor and it's the liabilities on me. So Verify Investor created a streamlined, simple process of taking that liability that would have come on the company and put it and kind of take it away from the company. So I think that all this technology will fix a lot of those problems, and we are dealing in the regulated world and all that. And so we should try to wrap this up because we're a little over time and we started a little late. So I would love for each person to give just a quick where we can find you, you know, promote whatever you're working on right now, and I will, you know, happily have any of you guys back, and we'll do this more often. It'll be a lot of fun. So let's go reverse order now. Kinsey, where can we find you, and tell us a little bit about PrimeTrust?
You can find me via email, kinsey@primetrust.com, on Twitter or on LinkedIn under Kinsey Cronin. And PrimeTrust is a tech-driven trust company that provides the services of a regulated financial institution to crypto and equity crowdfunding companies as a back-end service so that they can build their business without needing to do all of the funds processing that's involved. Cool.
Jor.
Yeah, for me, it's simple, easy to remember. Contact Jor at prettygooddomain.com. If you're trying to get in touch with tZero, sales@tZero.com. If you're trying to get in touch with Verify Investor, just support@verifyinvestor.com.
Love it. And Andrew.
Yeah, please visit and read crowdfundinsider.com. That's crowdfundinsider.com. We cover all of fintech, including STOs and other forms of online capital formation. If you want to get a hold of me, tweet me directly at Andrew R. Dix, D-I-X, on Twitter, and I'd love to hear from you.
Awesome. And everyone, thank you for listening. Connect with me on LinkedIn, Alon Goren, or on Twitter. Go to securitytokensummit.com or cis.la and come hang out with us all in April. Thank you guys so much for coming. I really, really appreciate it.
Thank you.
Thank you. Bye.